This is our Forex blog for June 13th, 2011, and we released two new tools last Friday. One of them is the FX trend reversal alerts. This allows you to see trend reversals on 30-minute, hourly, 3-hour, 4 hours, and get audio, email, and or cell phone alerts. The 3 and 4 hour trend reversals tend to give reversals, not always immediately, but within 3 or 4 hours. Usually that last 3 to 5 day or 2 week trend is over, and it oftentimes reverses 30 to 50 pips. So, those are worth waking up for in the middle of the night to put on a trade, because typically the market reverses for a day, day and a half, 2 days. The other new tool is the FX IntelliStop, which uses our statistical trend tools to tighten or widen stops on your charts, and we'll go over those in today's blog as well. Like most days, we really want to buy the strongest pairs versus the weakest. You can see today the Swiss, without a doubt, was the strongest. There was no real clear weak currency all day, but the euro had the most peaks of weakness at 2. You might have been looking at 3 to sell the euro because it had incredible weakness. The daily, weekly, monthly trends down. A little bit of strength that then fell off a cliff, and it's usually safe to assume that the weakness will come back in if the longer term trend's down. So at 3, you might have looked at the Euro Swiss as a good one to sell. Here's 3 o'clock right here, and guess what? Within 2 hours it fell 80, 90 pips. And let's put our FX IntelliStop on here so you can see this in action. You don't want to adjust these settings. I'm going to go over this in a video in the future. It's still beta right now, and I'm going to be putting in additional tools to capture more of the trend. But you can use this as an entry method. You knew at 3 o'clock to look for sells. Here's 3 o'clock. Let's say you went short right here when it broke the hourly. You got stopped out. Small loss, break even, or small win. You went short again here. Let's just say 20.93. And the trailing stop, kind of got yanked up and then came back down. You got out of this trade down here. Absolutely huge profit using the currency meter to find the weakest ones, waiting for an entry, and then hanging with it until the trailing stop gets you out. And just for comparison purposes, let's put our regular chandelier stop on there so you can see how this intelligently adapts to how strong or weak the currencies are. So this got you out right here at 2021, and this one, with the close was above it. The close was right here at 29, so it made another 8 pips, but it also got you out of the trade about an hour earlier. It's just a tighter stop, and this, if you were buying down here and you're using a trailing stop, it got you out here versus down here. It's just a tighter stop. If the market's not super strong, it yanks itself closer, because the trade's not as likely to take off. Very strong pound today. However, the weekly and monthly trend are down, so look for small profits in that. You might decide to use a smaller than 5-minute chart, so you can use a smaller than 5-minute trailing stop, maybe a 2 or 3 minute. But it was super strong here at 4. One of the weaker ones was the CAD. If you look to buy the pound CAD today, you can see this trend was just straight up. And notice how this trailing stop got you out of this trade here at 42. The regular one got you out somewhere down here at 35. That's the 7 extra pips. And as far as the timing tool, notice strong trend, pulls back, you went long right here. No, I'm sorry, that went short. You went long right here, and as a timing tool, it got you in at 92, out somewhere up here near 42, for about a 50 pip profit. Now, when you're up near the upper containment band, there's less odds of it making more than a 10 or 20 or 30 pip max move, and then with the trailing stop being lagging behind price, figure a third of that eating up as the price comes down. So trades you take in the middle of the range using a trailing stop tend to have the biggest potential of potential pips. But as a timing tool, notice how it got you in here, out here with a small win, got back in again, and coming up to 2 to 4 o'clock, the currency meter, you can see at 2, the pound's weakness kind of disappeared. It really wasn't that strong. The CAD was actually pretty strong then, so you wouldn't have considered that. But once it showed up here on the currency meter, you wait for the next move, and as you saw, it caught a 50 pip move. The CAD also was Swiss weak, so you could have sold the CAD Swiss as well. Let's look at how this works as a timing tool. It was coming down to the hourly right here, and found some support, bounced, found some support, but didn't bounce, and that's a very high probability place to sell right here. And if you sold, seeing that our trailing stop was already short way up here, it kept you all the way in until right here at the bottom, 85.57 for an absolutely huge win in this, 50 or 60 pips. And if you got in, if you expected up here near the highs for it to fail, or you wanted to short every high, you got short here, small win, short here, small loss, short here. It actually had you short up here for an even bigger win. So you can use this as a timing tool, and it works on all time frames. Now the dollar, the weekly trend had shifted up, and the monthly trend just barely up, but it was having weakness today. 2 o'clock had some weakness. One of the stronger ones later in the day was the Swiss. So you might have looked to sell the dollar Swiss. It is, down significantly on the daily and longer term charts though. But if you wanted to look for shorts up near the upper containment band where most of the time the market reverses, let's put our IntelliTrend stop on here just so you can see, how it does and how it tightens very quickly when there's not much of a trend. See, if you're short here, notice there wasn't really that much of a statistical trend, so it had a tight stop, out with a small win on that one, maybe 10 pips. Short again, and it looks like it got stopped out right here with a small win on that one. Then it went short again right here, and it kept you short all the way down here to 62. Notice how tight that stop is. Just super tight. The lowest low was 55, and the trailing stop was at 62. Just an absolute, tremendous move. And one of the keys is small losses and big wins. That's one of the keys and secrets to trading. And the nice thing about this is it keeps your losses small because it's a super tight stop. And as soon as the momentum slows down, it tightens the stop dramatically. So you can watch this stop, and you can also use it to scalp. If you see the stop is just right above price, like right here, you could go short, for instance, if it breaks the low right here at 21, with your stop only 10 pips away. You can use it to get into trades later and know exactly what your risk is. Knowing that if the trend is still weak and there's no move up, you're going to catch occasional big move like this. And it doesn't take a rocket scientist to know to sell the dollar Swiss. The dollar Swiss has been one of the weakest currencies over the last few months. In fact, putting up a daily chart of this. Sorry, here, let me. Dollar Swiss, period D brings up the daily. You can see, this is just ridiculously weak currency. So at our upper containment bands, it's not unheard of, or nor is it really, in my opinion, too risky to look for sells, up near the upper containment band. As soon as this counter trend strength ends, and some weakness comes in, start looking for sells. Now, you might not have sold this until it came back underneath the previous week's high, because when it's above the previous week's high, it's pretty strong. It found some support right here. This is a very high probability place to go sell, and once it breaks the monthly pivot and the hourly, it's likely to come down to the lower containment bands, which gives you a potential profit of 40 pips while risking 10 pips. If you can take a trade that's maybe 60% likely to work with a 10 pip risk and a likely 40 pips or more profit, in this case it went beyond the previous day's low in the lower containment bands and it fell, and our trailing stop got you out another 37 pips lower than that. So in your profit estimation, you're expecting with a good chance, high probability 40 pips. You end up making 70 something, and so that's a phenomenal counter trend method for getting in. A lot of times counter trend trades don't work immediately. In this case it did. You had a small profit and then you had a huge profit. Got you short right here, right at an area that's likely to be support. If you use this new tool alongside support resistance areas, in other words, this area should act as support if it's going to continue up, and it doesn't. It doesn't get any bounce off of it. So when it breaks here, you're short, and obviously I think it got stopped out at some point with a small win right here, and then it went short again and they kept you in. You don't have to use this as a timing tool, but you certainly can if you choose to. For example, at 4 to 5 o'clock right here, if you brought up a 50 tick chart, let's put 50T here and bring up, has to download tick data, and at 4 to 5 o'clock right there, let's zoom this out so we can scroll back faster. If you use a tick chart for entry, knowing where your stop is, you have a little move down and a little sideways range here. You might go short here, and just stick with it, or on a little move up. You can't go higher right here at 20. You short it right here. What is the time right here? 5:18. You know exactly where your stop is. 5:18 is right around here. Your stop is at 21. So in this case, using a tick chart, if you're short right here at, let's say, 18 or 17, you have literally a 4 pip stop plus the spread. So it's a 5 or 6 pip stop, and your profit target becomes the fib target of the last wave down, maybe 03. It might have some support here. So there's a very high odds of making 16 to 17 pips while risking 5 to 7. And once the currency starts to move down, the trailing stop moves with it. And so your initial stop, most times when you're trading with the momentum and with the trend, most of the time your initial risk is not, if the trade doesn't work and you have a loss, and sometimes a break even, your losses are rarely, probably 1 out of 3 to 1 out of 4, 1 out of 5 times what your initial risk is. It'd have to break down and then immediately zap back up and hit your stop. Usually, when the currencies kind of have a counter trend move up a little bit, you can clearly look at the chart to see that people have kind of stopped buying at 84.20. They're not willing to pay up. Currency trading and all trading in general is an auction process. There's no more buyers up here on this move. There were buyers here that stopped the decline, no more sellers at the low. It worked its way up barely 10 pips, and there's no more buyers willing to pay up. And so that's why we prefer pullback trades. Come to our live classes to learn some other secrets that I don't reveal on our Forex blog, and everybody gets 2 weeks free access to our classes.